You don't want to miss this episode. We're going to break down 8 non-negotiables to look for in your infinite banking policy. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell. Joining me as always, Christina Wyatt. Christina, how are you doing today?
Hi, Darren. I'm doing great. Excited for another episode.
I'm very excited, and I just quickly wanted to say there's actually no such thing as an infinite banking policy. It's the infinite banking concept. It's a strategy. The product we use is a high cash value life insurance product, but you get the idea. The infinite banking policy. Technically, it's a cash surrender or cash value participating whole life, but it's the infinite banking concept. So for those IBC people out there that think I misspoke, it was just in the title. We're clarifying. So before we get started.
Yeah, before we jump in, I want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. If you're listening or watching on YouTube, please like, subscribe, and hit the bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All right, Christina, we meet with lots of Canadians coast to coast, and oftentimes they come in and they're like, I think I have one of these policies. I think I already have a policy. And we go, great, let's take a look at that policy. And we take a look at it, and lo and behold, you don't have it, the right product, the right structure, the right setup, the right company, all that stuff. So we're going to kind of go through today. What are the things to look for if you do have an existing policy, or if you're in the market for a new policy? What are the things you should be looking for to make sure you're properly set up? Your product is set up properly.
Yeah, looking for those red flags. I get this question a lot. People asking, what should we be looking for? What makes it an infinite banking policy? So yeah, I'm excited to go through those. Before we get into it, though, just this is more of a process than a product, though, right? And I think sometimes people jump into it that they talk just about the product. Is it the highest dividend? What's the loan rate? What's the flexibility? And they're like, which product, which company do I use? And it really comes down to the individual client and what they're trying to achieve. And I think that's something that gets missed sometimes with advisors out there, is that they jump straight to the product. This is the highest dividend, has to be the best. Right. Yeah. And that's not how it should be. You have, you want to find the right solution for the client. There's lots of different things that need to be looked at to do that.
Yeah. I think the process matters even more as much as the product. So you need to understand, how does this work? And that's why we call ourselves financial educators. We lead with education, books, podcasts, webinars, public speaking, all those things we do. You need to really be educated on this before you fully understand it, so you can actually use it the way it should be used, because utilization is the key. Again, we have so many people that come to us and we see a policy and it's like, well, you've actually had this policy set up for 10 or 20 years, or maybe it was a kid's policy that your parents had gifted you at some point, or you took over at their death. And it's like, do you know what you could be doing with this policy? And they have no idea what they could be doing with the policy, because no one ever sat down, taught them the process, taught them how the strategy works. And let's face it, there's a lot of advisors that sell a policy and you never hear from them again. So a couple key things there on the process and how it works. But now let's dig into the product.
Yeah, I want to just put one more note on that too, because when you said it, it made me think about it, is I'll run into people that had the perfect product and canceled it because no one taught them how to use it or utilize it. So these red flags also help for you finding out if you have the right product. Do not cancel it. Whatever you do, don't cancel it. Someone didn't teach you all of the great things that can come with it. So just want to throw that in there too.
All right, so let's get to non-negotiable number 1. This has to be a participating whole life policy. If it's a universal life, if it's a term insurance, if it's some other product other than participating whole life. So with the 3 or 4 companies that do participating whole life, or the one mutual company, it's the wrong product. That's real simple. Guaranteed cash value, fixed premiums, death benefit, guaranteed increasing cash values, dividend. All those things you're going to look for in the whole life. But the real simple thing, if it says UL, universal life, you don't have the right product.
Yeah, got to use the right product. Second piece, though, is how the product is structured. This comes into play, and something you want to look for is the amount of cash value available from day one. So when you're setting one of these up, you should be shown an illustration. And on the illustration, it's going to show you, here's your deposit and here's your cash value that you're going to have in year one. You should have 60 to 90% of your deposit available in cash value in year one. Now, it changes because of age, things like that. So that's why there's a variance there, right? But if you don't have, and I've seen it where 0 cash values in year one, crazy. I've also seen it, 20%, 30%. Like that is too low. It was not structured correctly if you do not have access to that money. And why that's important is because you want access to that money, right? We don't want to wait 8, 9, 10 years in order to start accessing this policy. We want to access it and use it for the infinite banking strategy immediately. So super important that you get the maximum available in year one. And you should be looking at that in illustration to make sure that it has that 60 to 90% for sure.
Yeah, great point. Because we're looking at this as our opportunity/emergency fund. And if it's set up and you're like, well, I'm not really going to need the cash value in the first couple of years, I'm not worried about it. And then all of a sudden, an amazing opportunity or emergency comes along, or just being able to have that flexibility to start and stop premiums and take a year off, all that stuff goes back to, are you structuring it properly with the overfunding up front to have that 60 to 90%, which leads us to the next one. By year 3 to 5, depending upon the carrier and the structure and your age and all that, your cash value should be growing by at least your deposit. Okay, so all these policies kind of start, we always compare them to doing a renovation on a property. You're not going to be rich year one. You're going to be rich long term. So you're always going to have less cash value in year one than your deposit. However, by year somewhere 3, 4, 5, you've got to be able to look at the illustration and say, okay, great, I've deposited 10,000. My cash value is going up by more than 10,000 or whatever your number is. So look for that. If it's not set up like that, it probably wasn't set up correctly or you weren't dealing with the right advisor.
Yep, that one's important too. The next one is the company. So this is important too. We pick the right product. We also pick the right company. And we want to, there's a couple rules we have when choosing the right company, and it goes with the company's strength, how long they've been around, right? So there's only 4 companies that we'll use for these policies. And the reason for that is, well, one, they have to have a participating whole life. That's number one. Number 2, we say that they have to have been around for at least 100 years. We like historical data. We want this. We want to see how it's done in that time period in at least 100 years. We also want to make sure in that 100 years they have always paid a dividend to their policyholders. That's a question. Ask that question. Have they always paid a dividend? How long have they been around? And on top of that, you want to make sure that the participating fund is at least $1 billion. So that's not little brand new funds. There's some companies out there that have recently just started participating whole life funds, and they look great right now because there's no historical data to show what they've actually done. So you don't want to pick something that you don't have the track record for. It's really important that you pick the right insurance company. Also, certain insurance companies have different flexibilities. They have different dividends most of the time. So don't just say, oh, the highest dividend is the best company. That's not correct, right? Because there's different flexibility pieces that some insurance companies will offer that others don't. Some will have different loan rates. Maybe you need access to money right away. It makes sense to go with a lower loan rate company. Some will have waiting periods for loans that you need to look into. You really want to look at your specific strategy, what you're trying to accomplish. Again, going back to rule number 1, what you're trying to accomplish, and make sure that the company and the product is going to allow you to achieve your goal that you're trying to achieve here, right?
Yep. Great point. And yeah, it's too late 10 years down the road to realize you're with the wrong company. So you got to make sure you do your due diligence up front. So sticking with premiums, with a properly structured whole life, there's always going to be a minimum premium and a maximum premium. And if you're fans of the show or have listened to us before, we love the maximum premium. That amount over the minimum up to the maximum, that's what really drives your cash value, especially in those early years. So we want the, typically, not in every case, but typically we're funding at or near the maximum premium. But we want to clearly know what is the minimum and maximum, because if you were to take a year off or 2 years off, or you just didn't want to pay the full amount, you need to know what that minimum premium is, and you need to know what that maximum premium is. So that's important, but you also want to know the flexibility. So what if you didn't have the ability to make the maximum premium for a couple of years? Couple questions are, well, can I go back and make up those premiums? And different companies have different rules. Or can I restart those contributions up to the maximum? Say you're only paying the minimum for 4 or 5 years. Can I restart the contributions up to the maximum without medical evidence? Because again, that's a big issue is, oh, I'm going to overfund this later. I'm just going to pay the minimum now. You wait to a period of time, and the company you're with says, okay, if you want to overfund it now, we're going to need full medical evidence again. And then maybe your health isn't as great as it was when you applied. So you want to make sure up front, you know what that particular company's minimum, maximum, and flexibility about restarting that premium. Hugely important.
Yeah, and the flexibility piece. So some of this, going back to the illustration that I talked about earlier, where you want to check for the cash values, a lot of this is going to be on that illustration. Some of it is not. So important to ask the questions. That flexibility, some of it you won't see it written on the illustration, easy to see. So you want to ask those questions. Some of the stuff is really easy to see, though, right? Cash values easy to see. Minimums, maximums, easy to see. You should be able to see right on your illustration what the minimum is, what the maximum is. Another one, going into the next point, is how the dividend is paid out. So it is important for it to be an infinite, for high cash value policy that we use for infinite banking, that the paid up or the dividend is taken as a paid up addition. And you will see that there will be an option for your dividend, and you'll say next to it paid up additions, paid up options. Sometimes the wording's slightly different. But what that means is that each year when the dividend's paid, it is used to buy more whole life insurance, so increase the death benefit and increase the cash value. So that's where we see our growth. We want to keep it inside the policy so that it grows tax-free inside of the policy, and we have that uninterrupted compounding. There, people can set this up where it's a cash option, and I've seen it, and they'll be like, well, I get this dividend once a year. It's great. I have this cash coming in. That's not great. We're not going to have that uninterrupted compounding that we want. In order to have that, the money needs to go back in to grow the death benefit, grow the cash value. So extremely important that the dividend option, and there will be other options, the dividend option is paid up additions.
Yeah, we'll see sometimes 4, 5, 6 different options we can select when we're doing illustrations for clients. And in the history of our company, in the history of me in this business, there hasn't been one time when we didn't select paid up additions. It's just non-negotiable, paid up additions. To your point, those cash dividends or premium reduction, all these ones, all they're doing is they're stunting your growth, and they're not giving you more access to cash. You want access to cash, you can get a loan. It just basically long-term limits, stunts your cash value, your death benefit. Not a good strategy. Number 7, non-negotiable, easy loan access and clearly defined loan provisions. So what do I mean by that? So different companies have different amounts that you can borrow. Now, most of the ones we deal with are at 90%, but there's some companies out there that you can't access 90%. So you want to make sure, is it contractual? Can you access the money? What's the contract say? What percent? Because you want to be able to access as much cash as possible. The next thing is, oftentimes, especially in, say, later years in retirement, we're doing the insured retirement strategy, or if you have a corporate-owned policy and you're looking to get a loan in retirement, maybe for your personal income, something along that line, we're going to go to a third-party lending institution. What does that mean? It means we're going to go to a bank, and typically we're going to deal with not the big 5, although they'll do it. We'll deal with a bank that specializes in loaning against insurance policies. And these companies that loan against insurance policies absolutely love whole life. They love to loan against whole life. Now, why would they love to loan against whole life? Well, if you're a lending institution and you loan money and you loan to a real estate investor and say, great, I'm buying this property. Well, what are the risks that the lender incurs? Well, that property could go down in value. That property could burn. The person that owns the property could die. The tenants could stop paying and the person goes bankrupt. They could destroy the place. They could get 10 pit bulls in one apartment and rip the whole place apart.
You're scaring investors here.
Possible. But if you're a lending institution, you got to think of worst case scenario. You're thinking worst case scenario, am I confident I'm going to get my money back? So that's why on a real estate deal, they're typically going to loan 70, 75, maybe up to 80% of the value of the property because there's risk involved there for the lender. Well, when we think of a lender loaning on cash value, what's the likelihood the cash value will go down? Well, it's zero. It's guaranteed to go up every year, even if it didn't pay a dividend, which it has for 100 or 150 years for the companies we're dealing with. So they know with certainty that's going to happen. What's the other risk the lending institution would have? Well, what if this person I'm lending money to against their cash value dies? Then how do I get paid? Oh, wait a minute. We have a tax-free death benefit that is higher than the cash value that is guaranteed to be paid out at death tax-free. So there's a bag of money to repay that loan. So from the lending perspective, they love this stuff because they know they're going to get paid. You're either going to repay it because your cash value went up or you're going to die. Either way, they're getting paid. However, these lending institutions, they don't loan on every insurance company and every product out there. They have a very specific list that they say, we will loan on whole life policies from these particular companies. UL, we will loan typically at 50% in these particular companies. So you want to plan long-term. You might think, well, I'm not going to do a bank-owned loan. I'm not going to do that. You want to have as much contingencies and options in your retirement planning as you possibly can. So you need to make sure you're dealing with a company that's on those lists of the big lending institutions that specialize in this.
Yeah, no, that's extremely important, especially in the later years. If you think you're going to be using it for retirement, and then
the corporate cases too,
yeah, very important. But what leads me to the last one is the most important one, number 8. And this is dealing exclusively with a firm that specializes in this. You can avoid every single mistake that we just talked about today by working with someone that knows what they're doing, right? You want to make sure that the firm that you're working with is very knowledgeable on the strategy. This is not the first time that they've went and run an illustration to show because you brought it up to them. I can't count how many times someone said, well, I brought up the policies to my investment advisor and they're like, oh yeah, I can do that. And they start running the numbers and I'm like, oh dear, like just stay. Sometimes you just got to stay in your lane. Investment advisor might not be right for you to be giving advice on something you're not 100% on. So it's important to work with someone that specializes in this. This is what they do 100% of the time. They spend a lot of time and education on it. Another piece of it is, does the firm that you're working with assist with policy services and loans, right? So our office is a fully servicing office when it comes to these policies. This is all we do, right? So we've got a full team that helps with policy loans. They help with if you need reports for accountants. You need someone to sit down with your accountant and your lawyer to be able to explain exactly what you're doing, to work with your accountant to set some of these lending strategies in retirement can be pretty complex. I'm not going to lie. Like it takes a little bit of strategy. I've got to bring in accountants. We've got to work together, make sure that it all fits and works for you and for your planning. Not saying it won't work, but if you have someone that doesn't know what you're doing, it probably isn't going to work. And there can be major pitfalls in the planning if they don't understand it. And when I mean pitfalls, I mean taxes, major taxes that can end up being paid if you don't do some of this stuff correctly. So extremely important to work with the team that understands it. They're around. Like sometimes, you're working with an advisor that's going to retire in the next 10 years. That's not ideal if you're going to be around for another, how many years there is. But so it's super important, I guess. And what I'm trying to say is to work with someone that understands it, can find these pitfalls for you before. You don't have to learn from your own mistakes with this stuff. There are people that specialize in it, right? And you can work with those individuals.
I love that. Learn from your own mistakes. Like, you think of the thousands of policies that we've looked at, we've assisted people with, like that experience to say, oh, well, here's your answer to this question, or something comes up and, let's face it, things always come up and it's like, how do we deal with that? Oh, well, I had that before. Let me show you how to deal with this. It's just so valuable. All right. So those were the 8 non-negotiables. So if we do a little quick recap here, here's the 8. It's got to be participating whole life. Can't be UL. Number 1, Your cash value in year one is going to be at least 60 to 90% of your deposit. Number 3, your cash value by year somewhere 3, 4, or 5 has to be growing at least by your deposit. Number 4, at least a 100-year track record, $1 billion of consistently paying a dividend from a participating whole life fund or mutual company. Number 5, clearly minimum and maximum premiums. You need to know what your minimum is, what your maximum is, and you need to clearly identify what kind of flexibility you have if you want to start and restart those. We want paid up additions as our dividend option, just non-negotiable, no questions asked. 7, you want to know how much loan can I get? Is it contractual? And will those other lending institutions loan against the product and the policy and the design I have? And number 8, you want to be dealing with a firm that specializes in this. And again, this is all we do. We have the experience, we have the team, we have the knowledge, and we're going to be around for the next 50 years to make sure when you're using that policy, not just today and tomorrow, but in 10, 20, 30, 40 years. Because again, you're planning long-term here. You got to be planning with a firm that's going to be around long-term to help you deal with this in retirement. So those are the 8 things, Christina, non-negotiables. Anything else before we wrap up?
I think we got a checklist there. I like it.
All right. So remember, it's the process, not the product. But if you want to get into the product, these are 8 non-negotiables. Thanks for watching. Thanks for listening. Have an awesome day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.